Welcome all the viewers. Dr. Vijay's lectures on accounting, lecture number 14. Adjusting entries continues. In the previous lecture, we have discussed about adjusting and reversing entries for expenses outstanding, expenses prepaid, incomes accrued but not received, and incomes received in advance. Here, we are dealing with adjusting entries and closing entries for depreciation, provision for doubtful debts and discounts, and interest on capital and interest on drawings. Let us go to slide 2. Slide 2 deals with adjusting entries for depreciation of fixed assets. Depreciation is the fall in the value of fixed assets like furniture and fittings, plant and machinery, land and buildings, motor vehicles, etc., through wear and tear, old age, and obsolescence. Different methods of writing of depreciation, like fixed installment method, written down value method or reducing installment method, revaluation method, fund method, and annuity method, are used for calculating the amount of depreciation and writing it off, depending on the nature of the asset, duration of life of the asset, and extent of fall in the value, etc. The most commonly used are the first three methods. In all those methods, the amount of depreciation is calculated and it is credited in the asset account and debited in depreciation account. Depreciation account represents a loss, so in nominal account, it is closed by transferring the balance standing into profit and loss account. As the asset is credited with the amount of depreciation, the value of the asset comes down. Slide 3 deals with provision for bad and doubtful debts. Any provision for covering an anticipated expenditure or loss is created, debiting profit loss account and crediting the provision account. Any provision made at the end of a period to cover bad debts occurring on the subsequent period will be carried forward, showing credit balance in trial balance at the end of the subsequent period. On attempting to set off the bad debts of the current period out of the provision that was created for that purpose in the previous period, whatever shortage or surplus arises can be adjusted only against the current period's profit. Moreover, a new provision will have to be made for bad debts occurring in the subsequent period. That is new provision. The following formula can be used to calculate how much amount to be transferred from profit loss account to provision account or back in each accounting period. New provision plus bad debts minus old provision. New provision means the provision to be created during the current period for covering the bad debts of the subsequent period. Bad debts means bad debts occurred during the current period, occurred before preparation of trial balance, and any additional bad debts occurred after that. Old provision means provision that was created in the previous period whose balance of which is brought down and is shown under credit side of trial balance. Okay, the formula is new provision plus bad debts minus old provision. If the resulting value is a positive figure, debit that in profit loss account. If it is a negative value, it shows that the old provision is so high that it still has surplus after setting off the bad debts of the current period and the new provision to be done. It has to be credited in the profit loss account. See the table given below for all the possible modes of adjustments regarding provision for bad debts. Slide 4 gives 11 various modes in which the adjustment of bad debts and provision for bad debts can occur in a problem given for working out profit loss account and a balance sheet. You have to choose which one of these applies in the problem given for you to working out. Column number first of the table, one of the table shows the serial numbers of the 11 modes. Column number 2 gives bad debts which is given trial balance. That means bad debts which is already written off, already transferred from personal account of the debtor to bad debts account. So it appears in trial balance. And now additional bad debts is third column, that is given additional information. It has become irrecoverable but not written off so far. So it is to be transferred still from the personal account of debtor to bad debts account. Now the fourth column is for plus sign, then new provision. New provision is given additional information. Provision that you have to create this time, this year, this period, at the end of this period by transferring from this period's profit for writing of bad debts of the subsequent period. Then column for minus sign, then column for old provision. Old provision will appear in trial balance credit side as provision for bad debts or reserve for bad debts. That was provision created in the previous period for writing of bad debts of the current period. Okay, then next column, a profit loss account debit column. If you want to show the amount in profit loss account debit column, it will be shown there. If you want to show the amount on profit loss account credit side, that will be shown in the last column. Okay, let us see modes one by one. Mode 1, bad debts given trial balance 1,000. No additional bad debts, no new provision, no old provision. You simply show that in profit loss account debit side because that is loss. Okay, in trial balance from sun debtors, nothing to be subtracted. So that as is given in the balance sheet. Now mode number 2, bad debts 1,000, additional bad debts 100. New provision nil, old provision nil. So this 1,100 you have to show in the debit side of profit loss account. In balance sheet from sun debtors, you should subtract additional bad debts 100. Now mode 3, bad debts 1,000, additional bad debts 100, new provision 1,500, old provision nil. So applying the formula bad debts plus new provision minus old provision, bad debts is 1,100, new provision 1,500 and old provision 0. So 2,600 we have to show in the debit side of profit loss account. And in balance sheet from sun debtors, new bad debts 100 and a new provision 1,500 to be subtracted. Now mode 4, bad debts 1,000, new provision 100, additional bad debts 100, new provision 1,500, old provision 1,200. Applying the formula bad debts plus new provision minus old provision, 1,100 plus 1,500, that is 2,600, minus old provision 1,200. So what comes out is positive 1,400. You have to show that in debit side of profit loss account. In balance sheet from sun debtors, you have to subtract this additional bad debts and a new provision. And mode 5, bad debts 1,000, additional bad debts 100, new provision 1,500, old provision 4,000. So bad debts plus new provision minus old provision means 1,100 plus 1,500, that is 2,600, minus 4,000, and negative 1,400, that will show on profit loss account credit side. And in balance sheet from sun debtors, you have to subtract additional bad debts 100 and new provision 1,500. And mode 6, no bad debts, no additional bad debts, new provision 1,500, old provision 1,400. So out of new provision required is 1,500, old provision was only 1,100, 400 more is to make that old provision equal to 1,500. So in profit loss account deficit 400. From balance sheet in sun debtors 1,500, new provision to be subtracted. Mode 7, bad debt 0, additional provision, bad debt 0, new provision 1,500, old provision 0. 1,500 you have to show in debit side of profit loss account, and from balance sheet sun debtors you have to subtract the same 1,500. Now 8, bad debt 0, additional bad debt 0, new provision 0, old provision 1,100. There is 1,100 provision for writing of bad debts of this period, no bad debts received this period. So this 1,100 we have to revert back to profit loss account. So it comes on credit side of profit loss account 1,100. In balance sheet from sun debtors, nothing to be deducted. 9, bad debt 0, additional bad debt 0, new provision 1,500, old provision 2,600. So negative 1,100 comes, you can show that in profit loss account credit side. From sun debtors 1,500, new provision to be subtracted. And mode 10, bad debts 1,000, additional bad debts 0, new provision 0, old provision 1,500. After writing off the bad debts 1,000, still there is a surplus of 400 old provision that you can show as profit on the credit side of profit loss account. In balance sheet from Sun debtors, nothing to be subtracted. And 11, mode 11, bad debts 1,000, additional bad debts 100, new provision nil, old provision 800. 1,100 is bad debts, old provision kept over was only 800. Therefore, 300 more you require that to show in debit side of profit loss account. From balance sheet, from Sun debtors, you have to subtract 100. Okay. Slide 5 explains provision for discount on debtors. In the pattern of provision for doubtful debts, a firm can maintain a provision for discounts allowed to customers. The amount of such provision required is to be calculated if stated a certain percentage of debtors only for the good or current debts, that is for Sun debtors minus new provision for bad debts, because discounts are allowed only for those who clears their debts promptly. As the provision is provided every year, the same formula as that of provision for doubtful debts is applicable. New provision plus discount allowed minus old provision. If the resulting value is positive, debit that amount in profit loss account. If it is negative, credit that amount in profit loss account. The table given in slide 4 gives different modes in which the provision can occur in a problem given to work out. Slide 6 is provision for discount on creditors. In the pattern of provision for discounts allowed to customers, a firm can maintain a provision for discounts anticipated to be gained from the creditors also. It will normally be stated as certain percentage of creditors. The provision is against a convention of conservatism, but is followed by some firms. Same formula as in slide 4 applies, but the impact on profit loss account is on the opposite sides. New provision plus discount received minus old provision. If the resulting value is positive, give credit to profit loss account. If negative, debit that in profit loss account. Same table as shown in slide 4 is applicable for different possible modes regarding provision for discount on creditors. Slide 7 deals with interest on capital and interest on drawings. With this slide, this lecture concludes. Thank you for your participation till the end. Please subscribe if you have not subscribed to this lecture so far. Please share maximum possible to your friends and relatives, whoever will be benefited by this accounting class. Your feedback is highly appreciated. In partnership firms, there is practice of allowing interest on capital and charging interest on drawings for each partner, with the object of making distribution of profits more equitable and to have control over drawings of partners. But some single owner firms also do provide interest on capital and interest on drawings. Rate at which it is to be provided is normally stated in additional information. At Sabu's firm, it is decided to provide $300 interest on capital and $400 interest on drawings for January 2020. The adjusting entries are for interest on capital account debtor to capital account, $300. And for interest on drawings, capital account debtor to interest on drawings, $100. Both the accounts are closed by transferring their balances to profit loss account, both interest on capital account and interest on drawings account. Interest on capital is an assumed expenditure and so debited in profit loss account. And interest on drawings is an assumed income and so credited. Thank you.